This is Michael Fox, and this is the Prospector News Podcast. And joining me is regular contributor Chris Temple of the National Investor. Another week, Chris?
Boy, oh boy. I mean, it's whoever sells Dramamine is making a fortune.
Yeah, well, as I often tell people, don't need reasons to drink, good to have them. And by the way, happy St. Patrick's Day.
Absolutely, and to you and everybody else out there.
So the inflation numbers have come in for both CPI and PPI, and they were a little less than what was expected. So I guess a smidge of good news.
That was some good news, and of course, it's led some people to publicly browbeat the Federal Reserve out of raising interest rates at all at its meeting next week with the banking crisis and everything that we may be at the beginning of, or maybe a flash in the pan. We still don't know. It's probably going to end up being the former. But at the same time, that producer prices, especially month after month, actually ticked down a little bit, even though they're still up, I think, the better part of 5% year over year. You've still got the stickiest areas that Fed Chairman Jerome Powell has been carping about: services, rents, things like that, that are still right up near the highest that they've been. There's been a little bit of help from energy, more so this week with oil collapsing. That'll help out next, March's numbers, I'm sure. But there's still an awful lot that's become entrenched in the economy, and it's still going to take some time for that to play out, Mike. I've been a believer from the get-go that no matter how much the Fed is able to tighten, until circumstances finally force their hand to stop, and we may be near that point finally, they're going to stop at a place where inflation is very far from their target and with little near-term prospect of getting there. Now, they'll try and tell us that it's going in the right direction to rationalize maybe skipping the May meeting and not hiking then, all things being equal. But we'll see. I mean, this, as we've talked about many times, and as people need to understand, all of these problems, the high inflation, overreacting perhaps in the other direction to try and bring it down, that now leading to trouble in the banking system with a lot of debt that was taken on at low levels by banks and other investors being underwater because of the rise in interest rates. I mean, the Fed caused all this. So they're always chasing their tail, trying to figure out what do we do to unscrew up the last thing we did screw up without screwing up something new. So for present purposes, they can crow about a couple of areas of inflation. Frankly, I think that the most help they're going to be getting on the inflation front is that this episode, even though depositors have been made whole in Silicon Valley Bank and in Signature, you look at Silicon Valley Bank especially, that was the poster child for modern banking, not only the woke politics that was involved there, but more so the fact that that bank, disproportionately to anybody else, was the enabler and depository for all manner of tech and other startups. And that probably is the biggest help the Fed is going to be getting from here forward on inflation, is that you just scared the hell out of lots of people who now are going to put back on the shelf any idea of taking a company public, merging with somebody, doing an IPO, I mean, all of this kind of thing. So that is definitely going to put a dent in financing activity generally and in startups specifically. Is it going to be enough to bring the price of rent and groceries down? No, but it is going to have a dampening effect as this all plays out on the economy. So at least the Fed will get some help on that front.
Yeah, definitely. There was, several things that came to mind as you were listing all that off. One was I laugh at Joe Biden when he says that we're going to find the malfeasant operators. I've just got this picture of him perp walking Janet Yellen out of his cabinet, but I'm guessing that's a pipe dream, and that's probably not going to happen. The making the creditors whole. And I think that the reason that that actually happened in this case is it was so disproportionately with a lot of heavy tech startups, and that being such a key element to the American economy. I think that they had no choice but to make those those depositors whole, or completely decimate, the US's tech industry.
Well, you're right. I mean, look, this last week you had companies like Etsy and Roku. Those are a couple of names that I remember, but there's many others that had accounts at Silicon Valley Bank way in excess of the FDIC insurance limits. There are companies in there that have parked their money there, still having to pay people ahead of going public. And you were talking about the prospect of, I don't know how many tens of thousands of people not getting a paycheck this week. And sure, that would have really sent everybody and everything reeling. So I guess looking at what the least bad outcome was, yeah, you have to at least make the depositors whole, make sure those people get their paychecks. The Fed is already trying to spin this, and with, I'll give them a little bit of credit with some justification that they're still going to find a way to punish investors. I wrote something, I think it was Monday morning, I sent it out, comparing this in one sense to China, when Evergrande, the biggest real estate firm on the planet, and it being leveraged umpteen times over, started to fail. China decided that they were going to pull off what they called a marketized default, and as best as they could, make sure little people don't get hurt too bad. But for large investors and other institutions, they enforced losses. I mean, to the point with Evergrande of people getting deeds for a fraction of a piece of real estate that's liquid. And they said, okay, you're paid off. Here, it's your problem later on to sell it, but here, you own this. The mutual fund industry in this country, if the stock market ever blew a major gasket, they can do that. The average people that invest in mutual funds don't even know that you've got a similar payment in kind provision where your mutual fund is concerned. So all of this stems from, at its core, a system that is what is called a fractional reserve banking system. And as time goes on, we don't have time to get into all of this today, but I'll be putting out a new series of videos, in fact, on this in the very near future, to give people a tutorial about what got us into this mess. But as time goes on, you have interest on top of interest, leverage on top of leverage, to the point where we're at now, where in the case of Silicon Valley Bank, they had a lot of deposits burning a hole in their pocket. They decided to do what at the time seemed like a prudent thing, perhaps, and invest some of that money in longer dated paper, either not realizing or not believing that the Fed was going to go as far as they did, raising interest rates to the point where, long-term bonds that they bought that might have been yielding 1.5% 18 months ago are now yielding 4 or 5 in the market, and meaning that the principal value of what they bought was well underwater. And everybody is in this boat that's a financial institution. So, again, the Fed caused this problem. Now the Fed's got to try and clean it up. And, we're past the point where in a situation like that, you can say, well, the heck with the depositors, but like Evergrande and like what China's doing, somebody's got to pay. They can't paper over everything. And so if you had the unfortunate circumstance of listening to CNBC's court jester, Jim Cramer, barely a month ago, when he told you how cheap SVB was at $320 a share, and you bought stock in that bank at $320 a share, kiss it goodbye, it's gone.
Yeah, but Jim Cramer is Jimmy the Greek of stock picking. Like I listen to what Jim Cramer says and I go the opposite way.
Well, which is why you now, among other things, have an ETF that's an inverse Cramer ETF. Whatever he says, they take the other side of it.
Yeah.
And again, it's not because he's an idiot, it's because he's doing a job, and his job is to be like a circus clown, carnival barker, game show host, And part and parcel, Mike, of in our adult lifetimes, you and I, we've gone from a very sober, deliberate, sensible world of investing to now it's a casino because you've got so much leverage. And to keep the system alive, you need ever more leverage. And in order to get that and get the public on board, you have these personalities out there that are, shills at an auction, that are getting the hoi polloi out there among investors to make sure everybody stays engaged with this whole skyscraper of cards.
Yeah. Well, you alluded to the fractional banking reserves, and they've gone well past what they were intended to be when they were started in the 1930s. You have derivatives that are working on fractional banking reserves. I remember talking a number of years ago to this young lad who was a big proponent of cryptocurrencies, and I said, "You know what's wrong with it, right?" No. There's fixed number. And I said, until the banks get a hold of it and they fractionalize it and they sell it off as ETFs. Yeah. And then the cryptocurrencies are done because you'll be buying, Bitcoins that don't exist.
Right.
Not that Bitcoins exist in the first place, but you get my point.
Oh, yeah. Although comically this week, along with gold flying, as people are wanting to be any place but the banks, Bitcoin has had a major rally as well, which I wouldn't be chasing. But it just goes to show how a lot of people are just kind of wanting to go in the other direction as far and as fast as they can, and that means buying gold or Bitcoin or taking your money out of your local bank, putting it in Wells Fargo or Bank of America so that you get covered. What if, your bank goes, that's what people are doing. So, it's kind of hard to quantify this whole thing right now. I tend to like to listen to people if I go out to dinner or the country club or someplace like that. Are people there talking about this themselves? Is this something that people are obsessing over instead of talking about Taylor Swift on Facebook? And I just don't see that yet. So,
well, it is and it isn't. I've noticed if I'm talking with younger people who are renting, as opposed to us older people that have mortgages, the younger people are freaking out. And the reason is their rent keeps jumping. And if they're lucky enough to be in an area that's rent controlled, it's still jumping. But if they leave their rent controlled protection, the jump is huge. And some of that is actually being reflected in the CPI. I read a number, and I don't know if it's accurate or not, that suggests that 70% of the CPI had to do with housing.
I don't know that 70% number is accurate unless they're throwing in utilities and other household expenses. But
that's possible.
But it goes to the point I said earlier that Powell is getting some help right now from energy collapsing again this week, which is more of a trading phenomenon than it is anything to do with supply and demand. He's getting some help from the scare in the financial markets. It's going to certainly put a dent in new startups and economic activity that ripples from that. More of that is going to impact financial firms, though, that usually scalp a piece of financings and things like that. I don't know that even Silicon Valley Bank is going to matter much if you're a worker in the oil patch in Texas or if you're in the upper Midwest or something like that. But yeah, I mean, look, we still need to go back. And not that the Fed is going to forever get beaten over the head with this, because they're making new mistakes now. But who was the guy in the first place, starting in the late winter, early spring of 2020, that printed something on the order of 30% of the U.S. dollars that have ever been created in the history of this country? You don't do that and sop it up in a year.
No, you don't. And you talk about the Fed making mistakes anew. buried in the depositors, being made whole, there was this interesting little piece that the Fed will buy the bad paper again at face value. So if you're underwater with your investments on the treasuries, you could sell those treasuries at face back to the Fed at face value. So as far as I'm concerned, that just sounds like quantitative easing with another name. I did a back of napkin kind of calculation, and I'm probably low on the number, but given that the estimated unreported losses on these treasuries was somewhere in the neighborhood of 640 billion, that's with a B, dollars, my back of napkin just said that the Fed just came out with a 1.3, $1.4 trillion quantitative easing program to sop up the bad treasury paper.
Well, they did, in a manner of speaking, first of all, that new, and it's a credit facility that they came up with. You don't have to actually sell your paper, excuse me, to the Fed to get par. If you're a bank that has some of these bonds that are underwater, they will loan you money based on par. And then when these things mature, you just give it back to the Fed. Now, the mechanics of that, you could say, well, we're 6 of one, half dozen of the other. And in a sense, it is. What the Fed is going to be at some pains to do when at least a few of the members of Congress that understand this stuff quiz them on it is, how is this not quantitative easing? Because everybody in the last couple of days has been bandying about the chart from the St. Louis Fed that shows all manner of statistics, including the size of the Fed's balance sheet, which in 1 week has grown some $300 billion, almost half of what they have unwound since they started their purported quantitative tightening belatedly about the middle of last year. So some are going to say, well, it's just an accounting thing. It's on the Fed's balance sheet this week, but it may not be there next week because it's part of their whatever. Now, the Fed engages in open market operations and overnight things every day, and you don't see it show up on the balance sheet. So this is going to be interesting to see how the Fed sells this or explains this. Next week, of course, there's a FOMC meeting at which it's generally expected that the Fed will split the difference. They'll raise rates 1/4 of a point next week, not 50 basis points like that dingbat over in Europe just did today, Lagarde. And then Powell is going to have to explain why after that everything is off the table, and we're just going to have to really now go meeting to meeting and figure things out. I suspect that in that room, unlike when he was in front of Congress for his recent testimony, where you just get moronic questions because they're being asked by morons, how is he going to explain away their balance sheet lurching back in the other direction? Is he going to be, like one senator tried to do to Janet Yellen yesterday on the whole question of whose bank is going to be deemed systemically important and who isn't? Are you going to force everybody out of small local community banks and we all need to be in the big banks? That's part of the game plan, in my opinion. But are we going to see Powell be forced to admit, like Janet Yellen was trying to dodge, that we're going to protect the big banks, we're going to print everything we have to print to keep the big banks in the main system afloat? And so if you don't like it, sue us. I mean, does he really want to admit that he's got to run up the white flag now when inflation has still not been tamed? So this is going to be interesting.
Now, there's certainly going to be a tap dance going on, and I have to say, I hope you're wrong about the small banks. I deal with a one branch credit union, so I literally can't deal with a smaller bank than I already have. So,
well, one of the things,
if it's in trouble, then I don't know what I'm going to do. I guess the money in the mattress might have to come into play.
Well, and it's why some people, I'm sure, are withdrawing cash from banks. If that's not an unwise thing to do. Maybe they're going to top off their physical stores of gold and silver coins. Gold and silver have had a great week this week. Some even want to, go back into Bitcoin and the security tokens and things like that, which, can't hardly blame them, even though I've always looked at those areas with kind of a jaundiced eye. But we'll see what happens. I mean, look, it's been an anachronism for so long anyway. I mean, they increased the FDIC deposit limit in the wake of 2008, but what did they do in 2008? Pretty much all depositors that were in trouble still got their money. So, they should be a little bit more honest and say, look, every bank now is systemically important, because if any depositors lose their money in our Ponzi scheme, we're going to have a revolution, and we don't want that.
Yeah, well, FDIC is less about insuring the deposits than it is about taking and unwinding the banks that fail. They'll make the depositors whole, and then they'll unwind the bank and move on.
Well, but at some point it becomes overwhelming, and especially in this case when the math just doesn't work and the FDIC can't begin to cover more than just one or two isolated bank failures. It's like the state I live in. I was having this talk with Dana, my wife, this morning. Look at the insurers in the state of Florida in recent years that have gone belly up, because after a lull, you had a greater than average incidence of hurricanes here in the last 6 or 7 years. And when you have more than is traditionally expected, companies didn't collect enough premiums, and some of them just fold their tents.
Try and get flood insurance in Louisiana.
Sure.
Bluntly can't be done.
So we're unfortunately, at least in this context, long past the point in this country, and again, thanks to the Fed and the nature of the system that we have that requires ever more debt, ever more leverage just to keep everything in play. All right. We're past a place where moral hazard can even be a part of the system to a great extent. They'll try and keep some there, again, with the shareholders, a lot of the bondholders and unsecured creditors of some of these banks and these institutions. They're going to take it in the rear end. No question about that, as they should. Should there also be the safeguard that we used to have, where people would think twice before having more than the insured limits in the bank? Yeah, well, that used to be a good idea as well, to not be over your skis if you were a depositor, but we're unfortunately past that point. So now deposits essentially have been socialized in this country. I don't think, going back to this grilling of Janet Yellen by this one senator from Oklahoma yesterday, even though she doesn't want to admit that it would come to this, I don't think they're in a place any longer where if we see other banks go, that they can say, all right, well, we covered these, but we're out of tricks and out of money and out of ideas. So the rest of these banks that are dropping, we can't cover them.
If you want a second American Revolution, that'd be a good way to start it.
It probably would, but yeah. So again, as a couple people have suggested in the wake of the government last Sunday evening announcing their game plan to cover all the depositors of Silicon Valley and Signature, the banks are going to become quasi utilities. The whole system has effectively just been nationalized.
Let's go through the big questions going into next week then. So I think you've answered the first one. What does the Fed do? You say a quarter point.
Yeah, they've got to save face. If they do nothing, maybe you get a little bit of a rally on Wall Street, but then at least a few of the saner heads will say, all right, this really is worse than the Fed wants to let on. If you stick with a quarter point hike and still talk tough about inflation and point out things like rent, like services and so forth that have not come down yet. You say, look, this is apples and oranges. We had a crisis with a couple banks over here. That's managed now. That does not mean that we stop our inflation fight, because if we don't continue to bring inflation back down, then we have ever more imbalances in the economy. We're going to need to play more catch up later, and we could have this same thing happen yet again. So I think that Powell, and you've already heard this somewhat in the financial press, that they're going to make the point that these are two very different problems that the Fed has got two different answers to, and it is not mutually exclusive for them to make sure that they protect financial market stability and the proper functioning of markets. That is not mutually exclusive with them continuing to fight inflation.
Okay, let's put a hypothetical. Let's say the Fed doesn't raise interest rates. Given what we discussed about the loan facility on the bank's reserve paper, is that officially a Fed pivot that everyone, has been talking about, and do the markets go, hyperbolically up?
Well, it would certainly be a Fed pause, and I think more than that, which is why they want to hike still 25 basis points and keep the door open to continue tightening if they think it's necessary. They do not want to admit that they've been licked and that they have to stop while inflation is still 2.5 times their supposed target, because then you really do embed in the minds of businesses and consumers and markets, everyone, that high inflation is here to stay, and that the Fed just had to admit that they just can't do any more to try and stop it. I don't think they want to do that. So would markets, at least initially, react favorably? Of course they would, but at some point I think you would get that question being asked, okay, what are we not being told? Because if the Fed is going to chicken out, especially after the ECB with Credit Suisse on the edge and everything else, just raising rates 50 basis points to add an exclamation point to their inflation fight. If the Fed does nothing, what are they afraid of? So a lot of what they're doing, even though they're usually full of more shit than a Christmas goose when they do any of this stuff, is trying to tell us whatever they think they have to tell us to manage expectations.
Okay, let's go the other way, because we talked 2 weeks ago, at the start of the week before all the banking fun started, Powell was in front of Congress implying that there was a 50 basis point on the table for the next raise. Does he go there, and what would that say? Does he? And we've already determined no. If he were to go there, what does that signify?
I think that would jolt everybody, and it would be the opposite of what I just said. As far as if he does nothing, it would be, holy cow, this guy really does have a death wish for the markets. Did he just come out from under a rock someplace and didn't pay attention? Was Janet Yellen the one handling all his bank stuff? So no, I think that given what has happened, and they can now have the excuse of producer prices this last week coming off the boil more than was expected, the collapse that there's been in oil again this week, although I think that's going to be fleeting. But they've got more than enough to hang their hat on to say, okay, we don't need to go quite so far as 50 basis points now. We'll just do a quarter and we'll watch. So I think he really scared the hell out of people if he did 50. And that definitely has been taken off the table by these banks.
And final question, they always say there's never just one cockroach. Is there more bank problems that could rear its head between now and the FOMC next week?
They're everywhere. I mean, the whole system, like we said earlier in the conversation, Mike, everybody to some extent or another is in the same boat that got SVB in trouble. The biggest thing that got them in trouble, and I still have not quite come to understand the reason why they did this specifically, but when they actually sold a lot of the securities that they had and took a significant loss, at the same time they're trying to talk people into depositing money anew and into investing, I think, in the bank itself anew, and that got everybody scared and run for the hills. There's a lot of people sitting on these paper losses that they don't have to mark to market except under certain circumstances. So yes, there's a lot of potential problems out there. Long before we heard about these banks in the last 7 or 8 days, Credit Suisse has been on the edge of going off the cliff for months. Deutsche Bank is not far behind it. This afternoon, Credit Suisse just was told by several big European banks that they're going to limit their activities with them. Credit Suisse just had to get a lifeline from the Swiss National Bank to keep everybody from running for the hills there any more than they already have. So no, there are more cockroaches. They may not be as big as this, Silicon Valley Bank, but there's still some out there. And I think that with this, all else being equal, with this new lending facility, where if you've got paper, you're a bank and you have paper on your own balance sheet that's underwater because of this big move in interest rates, and you need to raise money, you can do it at the Fed without the public ever having to know it, and without you ever having to sell these things and take the loss. So that part of the problem, they've done a lot to paper over. But beyond that, you've still got lots of leverage, lots of things that aren't working. And then, of course, the next nightmare is if the Fed is wrong and raising interest rates and what's already in the system does lead to more of a recession than is commonly understood. Now you're going to hurt these banks even more because people are going to be servicing their debts even less. And you might actually have a situation, and I alluded to this last week, where you look at the corporate debt market, the junk areas of that, you get back to something more of a traditional default rate, which you have in recessions. And that's something the banks could not weather either. So we'll see what happens. But again, this is, we've once upon a time, when I first got in this business over 40 years ago, we had a traditional business cycle that has long since been replaced by credit cycles. And every time these cycles repeat, it takes more money, more QE, lower interest rates, and the rest, just to first maintain the status quo and then maybe lead to some growth fueled by the expansion of credit. And then when it goes the other way, there's less ability for the economy organically to service all that new debt that was taken on. So you have another bust, you rinse and repeat, you have an even bigger QE program, but again, with correspondingly less benefit and oomph for the overall economy. All you're doing is papering over existing debts. There's not a whole lot of room. And this is why people need to be careful what they wish for. With, they say, well, the Fed's going to stop raising interest rates, they may even have to pivot, lower interest rates. Look, if you see that happen sooner rather than later, that means the Fed knows that the damage is already done. And you can have a recession and bear market play out for a long time after interest rates start coming down, because the damage has already been done.
Well, quite frankly, I wouldn't be ebullient about it. I'd be looking for the lifeboat.
Yeah. Yeah.
So if people want to get in touch with you or follow your musings, how would they do so?
Simply go to nationalinvestor.com. If you're not already part of my newsletter list, at least sign up for the free newsletter there. You'll get occasional special issues on different subjects, be it gold, story stocks, energy, whatever. The new FANGs is the new one now. General market commentaries like this.
Perfect. I guess we'll be talking to one another again next week after the FOMC, and by then I guess we'll know where Powell's head is at. Hopefully not where it's been at for the last little while and out in the open.
Right. That's a very good point.
Okay. Thanks again, Chris.
All right, Mike. Have a good weekend.
The Prospector News podcast is for educational purposes only. The opinions expressed are those of the participants and are not to be taken as investment advice. Listeners need to do their own due diligence and seek advice of a licensed investment advisor.